Okay, hello. So in this video, we're going to learn together about cost behavior. Okay, so this is one of the chapter for the midterm week. And okay, let's get started. So, foundation upon which managerial accounting is built. Why? Because when the manager of the company really understand about the behavior of its costs, later on, the manager of the company can make a necessary action for planning, controlling, and decision making. So the definition of the cost behavior describes whether a cost changes when the level of output is also changes. And based on its behavior, we have three types of the cost, which is variable cost, fixed cost, and mixed cost. Actually, we have another category. As you can see here, the step fixed cost and the step variable cost, but the nature of it is really rare and really difficult to find the exact example. So we just divide it into three types of category, three types of cost based on its behavior: fixed, mixed, variable. Okay. And then, okay, for the first type of the cost based on its behavior is the variable cost. And maybe we can understand it easily by using a graphic. Okay, so in here, we have the x-axis, which is refer for the quantity or unit. And then for the y-axis is for the rupiah or dollar. So as you can see here, let's say the company produced the donut. When the company produced the 10 donut, the total of variable cost is 1,000. And then when the unit of donut is increased, became 100, the total of variable cost became 10,000. So we can conclude that the variable cost is the cost that in total will increase as the units produced is also increased. Okay, so the more unit produced, the more also the total variable cost. But when we change as the variable cost per unit, the variable cost per unit will remain the same regardless how many units are produced. Just using this example, when the quantity is 10, the total of variable cost is 1,000. So 1,000 per 10, 1,000 divided with 10 is 100. So that's the number for the variable cost per unit, 100. And then the same amount also we can find by dividing this number, 10,000 per 100. The number of the variable cost per unit is also the same, 100. So please keep in mind that if you want to explain the definition of the variable cost, please not only explain by the point of view in its total. In total, the total of variable cost will also increase as the unit produced is also increased, but in unit will remain the same, will fix as more the units are produced. Okay, so that's for the variable cost. You can read it by yourself in here. The explanation is just the same with I just explained to you. Okay, so next we run into the second category of cost based on its behavior, which is the fixed cost. And this is the graphic of the fixed cost, the same. The x-axis is referred to quantity and the y-axis is referred to rupiahs. Okay, for the fixed cost, the total of the fixed cost will remain the same regardless how many units are produced. But in unit, the fixed cost per unit will change inversely with changes in volume or the quantity. So take a look at the example. The example of the fixed cost here is the total cost of supervision, and we have this number. Okay, so regardless how many numbers of computers are produced, the total cost of the supervision, which is the fixed cost in here, will remain the same. But when we calculate it per unit, as the more of computers produced, the less the number of the unit cost. This number divided with this number is this number. This number divided with this number is this number, decrease, and then until this number, when the number of computers produced is this number, the unit cost will decrease again. So that's the nature of the fixed cost. The total will remain the same, but in unit will change inversely with the changes of the volume. And okay, take a look in this definition. We have the keywords in here. Okay, so what is the relevant range in here? So the definition of fixed cost, which is as explained in here, a cost that in total are constant as the level of output increases or decreases, but in unit will decreases. But that definition is only applied within the relevant range. Okay, so what is the relevant range? The relevant range is the range of output over which the assumed cost relationship is valid for the normal operations of a firm. So maybe to understand it, I will explain like this. When we're talking about the relevant range, it's actually we're talking about the time horizon. For the example, we have a example of the fixed cost here, which is the rent expense. Okay, the rent expense for the building, Let's say the tariff of the rent expense started from 2016 until 2020 is the same, which is 5 million rupiahs per month. Okay, this is just example. Okay, this is just example. So in this range, 2016 until 2020, the rent expense is the fixed cost because the number will remain the same in this relevant range. Okay, let's say started from 2021 until the 5 years later, 2026, the rent expense per month is increased. Let's say becoming 7 million per month. So starting from this time, the rent expense is not again becoming the fixed cost because the number is increased. The number is not remain the same. So that's why, please always mention about the relevant range when we want to explain about the fixed cost. Okay, so that's why we have a conclusion here that in the long run, actually all costs are variable costs, but in the short run, at least one type of cost is fixed cost. Yeah, So that's the concept of the relevant range when we're talking about the cost behavior. Yeah, caution when applying cost behavior assumptions to output levels that fall outside of the company's relevant range of the operation. Okay. Okay, so now we enter to the third type of cost based on its behavior, which is the mixed cost. So what is the mixed cost? Mixed cost, as it name, literally that cost that have both a fixed and a variable component. And then if we take a look at this graphic, this is the graphic of the mixed cost. It has two lines. The first line is for the fixed component, the horizontal line, and then started from this point, this is the variable component. Okay, so mixed cost, there are fixed and variable element in here. And if we want to make a mathematical equation for the mixed cost, or the formula for the mixed cost is like this. So y equal with a plus bx. Y is referred to the total cost or the mixed cost itself, and then a refer to the total fixed cost, and then bx is referred to the variable cost. And then if we want to break down it is consists of two variable in here, two notion in here. The first one is b, that refer to variable cost per unit, and then x is referred to the number of units. So this is the formula or the mathematical equation of the mixed cost. And then, okay, finally, we already know that there are three types of the cost based on its behavior: variable, fixed, and mixed. And then if we relate or connect it with the production cost, this is the example of the production cost, and then we relate it to its behavior. Direct material and direct labor is the perfect example of the variable cost. Let's say this is the furniture company, and then the wood nail is the example of direct material, and then the salary that we pay to the carpenter is the direct labor cost. Two of them is the variable cost. This is logic because the more unit that the company produce, the company will also need the more wood, nail, and pay to the carpenter. And then, how about the mixed cost? Supervisor salary and the electricity is the perfect example of the mixed cost. Why? Because, yeah, it consists of variable and fixed component. Okay, just take a look at this illustration. Yeah, let's say I want to explain in detail about the supervisor salary, why this is the example of the mixed cost. So supervisor is the example of indirect labor. This is the person who the tax is for, like monitoring the direct labor while they working. So just monitoring and not directly connected with the production process. Let's say that the supervisor has a fixed salary per month, 3 million rupiahs. This salary is only applied for the basic normal working hour. But mostly, supervisor will also working outside the normal hour, or in other words, is on the extra hour. So because the supervisor also working outside the normal hour, the supervisor will get an additional salaries. Let's say that the tariff for per hour is 100,000 rupiah. So in total, starting from this moment when the supervisor working outside the normal hour, he will also get the additional salary, and this is the variable component. And that explanation also apply for the electricity cost. Whether the company use or not using the electricity in month, the company still have to pay the electricity cost, and that the fixed cost when the company is not using any kilowatt of the electricity. But after the company using and starting from that is the variable component of the electricity cost. Okay, so that's for the variable cost and then mixed cost. And then how about the fixed cost? Okay, so mostly you have to remember that the components of cost production is always three: direct material, direct labor, and factory overhead, FOH. In Indonesia, we call it FOH. Nah, direct material cost and direct labor cost is the perfect example of variable cost. And then mostly for the factory overhead cost will always as the fixed cost example. For instance, like the depreciation expense of the molding machine is the fixed cost. And then let's say the rent expense of the building is also the fixed cost component. Okay, so that's when we want to correlate the production cost with its behavior. And then we're still talking about the mixed cost in here. The mixed cost has an issue, not like the variable cost and fixed cost, because they are already entered to the category that really clear whether this is variable or fixed, but not for the mixed cost. The issue that we have to solve in the mixed cost is that we have also separate the variable component and the fixed component in the mixed cost. So that's our next discussion. Of course, this is really important for the manager of the company to separate the fixed and variable component in mixed cost. Why? Because as already explained in the very beginning, that understanding the nature of the behavior of cost in the company will make like the important decision to planning, controlling, and decision making. Like when we can control the cost, we can the cost, we can decline the cost, and then the company will get the more profit. Or when the company want to make a decision about the sales price, okay, it's really important matter to know the behavior of the cost. So that's why in the mixed cost, the important issue that we have to separate how much the fixed cost and then how much the variable cost. Okay, this is the explanation of the why we need to make a cost separation in the mixed cost. And then this is 1, 2, 3, 4, 5. This is 5 methods that are available to separate the mixed costs. Okay, we will discuss this one by one. For the first one, we call it the high-low method, and then scatterplot method, and then simple regression method, multiple regression method, and the last one we have management judgment method. Okay, so now we go to the high-low method. The high-low method is method of separating mixed cost into fixed and variable components by using just the high and low data points. So in here, this is the illustration how we make a calculation when the company choose the high-low method. So this is the example. We have a data from January to May, and then the setup cost in here is the mixed cost itself. And then the setup hours in here is the variable that become the reason why setup cost is incurred. Okay. The variable itself, it could be anything. It could be, like the direct labor hour, the machine hour, anything. But because we're talking about the mixed cost named setup cost, So the company already analyzed that the thing that make this occur, the setup cost occur, is because of the setup hours. So this is the cost driver of the setup cost. So we need the data about the total of the mixed cost each month, and then also the data about the total of setup hours each month. Okay, so for the first step for the hello method is we have to choose which one is the highest point and which one is the lowest point. So based on this data, we have May as the highest point, right? And then January as the lowest point. And then after that, we have to compute the B. Remember, B is referred to variable cost per unit. The formula to compute the B itself is just high cost minus low cost divided with high units minus low units. So we already choose that May is the highest point. So the next step is only this number minus with the lowest cost with this number, divide with high units in May, this number, minus with the low units in January, this number. So we calculate this, and then we found that the B is this number. Okay, that the first step. And then the second step is that you have to choose using either the high cost or low cost, solve for the total fixed cost. So the next step is we have to compute the A in here. After compute B, we have to compute A, or we call it the total fixed cost. So just using the mathematical equation procedure, yeah, we put it the number of B in each point, but you only choose one of it because this result will be the same whether you choose the high point or the low point. So this is the example of the calculation if we choose the high point. So just enter the Y is the total of the mixed cost equal with A, the thing that we want to compute, plus B, this is the number that we already compute, and the X that incurred in the high point in May, 500 in here. And then finally we can found the number of the A is this number. And then if you want to choose the lowest point, just the same, but we only differ the number. This is the lowest point. The Y in the January is this number, and then the X in January is this number. We just put the B in there, and then the result of the A will also the same. So that's why just using either the high or low cost point. And then, yeah, finally, we can make a conclusion. The complete mathematical equation for this case, yeah, Y equal with A plus BX, the Y, which is referred for the total cost, equal with, total cost in here is the setup cost, right? Equal with A, this number, plus B, multiply with the X. The X in here is the setup hours. So the complete formula using the hello method, like in this illustration, is like this. So finally, the company can compute for the rest other month, February, March, and April. So we have the column in here, total cost, and then this is the fixed cost column, and then this is the variable cost column. For the fixed cost column, the number is the A in here, right? A because refer to the fixed cost, and as you can see, starting from the January until the May, the number is remain the same. And then for the variable cost in here, we just subtract this number with the total cost. So this number minus this number is this number, etc. Until May, way to compute how much the variable cost is the same. Okay, so that's for the high-low method. And then we go to the next method, the scatterplot method. The scatterplot method, we using the, like making picture, and then the picture that produced in here is, of course, using the application. So maybe for the studying purpose in college, we cannot really make this into a reality that you really make a scatter graph method, but you only have to understand that what is the scatter graph method, because it's kind of impossible if we make a practicum of using this method in reality. Different with the high-low method, this is really easy to do, but not for the scatter graph method. And also actually for the next method, which is the least square method, also need the application to using that. Okay, so for the scatterplot method, yeah, scatterplot or scatter graph is just the same. It's a way to see the cost relationship by plotting the data points on the graph. So we have the data in here. Let's say this is data from February until December, and then this is the total cost, and then this is the like the variable itself, like in this example, setup cost and setup hours, but the title of this column is there is no explanation about the title of the column. It's okay. So this is the result of the scatterplot method. And then, as you can see here in the scatterplot method, the output is also the calculation, which is automatically processed by the application. And here for the example, we can see that the fixed cost number is this number. Okay, so this is the fixed cost component. And then this is for the variable cost component. And then also, if we want to compute how much the variable cost component, we literally only deduct the fixed cost component with the total cost or mixed cost per month. This is example, the number in for the total, for the average, yeah, for the average. And then, okay, so we have the variable component in here is this number that applied for all of the month. And this is the computation of the variable cost per unit. We just divide with variable component in here with the unit itself. So the unit itself, let's say that we want to compute for the October, right? So we just divide it with the variable that incurred, the cost driver that incurred on that month. Okay, so that for the scatter plot or scatter graph method. And then the next, for the least square method, we divide it again into two sub-methods, the simple regression and then multiple regression. So what is the difference between simple and multiple? I will explain it in advance. So the difference is that for the simple regression, the cost driver, the variable that incurring the mixed cost to be happen is only one variable. So this is applied for the case where the cost driver is only one variable. Like in this example, this is literally the example of the, if we want to using the simple regression method, because the variable that cause the setup cost to incur in here is the setup hour itself. So this is only consists of one variable, one cost driver that cause the setup cost to be incurred. And then when the cost driver or variable that cause the mixed cost to be incurred is more than one variable, we use the multiple regression least square method. So this is more than one variable. So that's the difference. how to compute it, how to we doing the method of this least square, whether it's simple or multiple, will always using the application like the SPSS, data, etc. And maybe the Excel we can doing by Excel to finish the computation of the simple regression and multiple regression. So yeah, this is a statistical way to find the best fitting length through a set of data points. So just the same like the scatter graph method, we just input all of the data starting from the range of time, January, let's say January until December, and then how much the mix cost per month, and then who is the cost driver, and then how many the cost driver, one variable or more than one variable, because it will make us to choose. This is why we using the sample regression and why we using the multiple regression. And then yeah, this is the example. We have the data January until May, the setup cost, the mixed cost itself, and then this is the variable that caused the setup cost to be incurred. And okay, the number is just the same with the illustration of the high-low method, yeah, but the difference is that in this example, we input all of this information in the statistic application, so the result will known automatically. We don't have to doing a manual computation like in the high-low method. So ta-da, this is the regression output, yeah, the output that that will automatically produce when we using the least square method. So actually there are many output in here. Sorry, okay, I will change it first with the black color. Okay, actually there are many number in here, but please just take a look, a deeper understanding with the yellow color, because that the output that we need to conclude how much the fixed cost component and then how much the variable cost component. For the constant output, which is this number, is referred to the fixed cost. Okay, and then for the X coefficient itself, this number is referred to B, the variable cost per unit. So in the regression method, in the least square method, whether it is simple or multiple, just the same, this is shown in the constant, and then this show in X coefficient result. So the thing that matter here is just you really understand which output that you will use to conclude how much the fixed cost and then how much the variable cost by using this picture regression output. So based on this example, we can conclude that setup cost equal with A, the A is in here, the fixed cost A, this number, plus BX. The B itself is this number, the X coefficient. So this number multiply with who is the cost driver in here? The cost driver in here, the thing that caused setup cost to be incurred is the setup hours. So like this. Nah, and then beside these two output that you really have to memorize, you also have to really understand the meaning of the R squared in here, right? R squared, or the other name is the coefficient determination. The explanation is in here. Is the percentage of variability in the dependent variable that explained by an independent variable. So the R square or the determination coefficient result explain about how much this setup hours can explain the setup cost to be incurred. So the R square always between 0 until 1. The number in here, it's mean this. So the more it close with 100%, the better that meaning. Okay. So when we have this number, so it's mean that 94, or I could say that 95%, the variability of the setup cost can be explained by the variability of the setup hours. So it really is that the setup hours is the only thing that cause the setup cost to be incurred. Let's say if the R squared, the result is only, let's say 40%. It's only 40%. So maybe the company will, like skeptics. Oh, maybe the cost driver that caused the setup cost to be incurred is not only the setup hours. Maybe the other thing like the direct labor hour, the machine hours, etc. The company needs to find out itself if the R square is really low, not even close with 90%. Okay, so that's why this is the perfect example of the simple least square, because it's only one variable, it's only one cost driver that caused the setup cost in here to be incurred, which is the setup hours, and the variability percentage, the R square, the determination coefficient result is really close with 100%. Okay. And then, how about the multiple regression? Multiple regression, just the same with the simple regression, only that different is the, because the variable is more than one, so the equation not only consists of one bx, but also the other bx. It's just the same. Total cost equal with A plus BX, but the BX in here, because the variable is more than one, the BX will also more than one. Okay, so the last method, we finally go to the last method to separate the mixed cost, is the management judgment. Among all of this method, only management judgment that not include the computation. It really just the judgment of the manager. Okay, the managerial judgment is critically important in determining cost behavior, and it is by far the most widely used method in practice. Why? Because it's simple. The manager itself has already analyzed many data, has already know the pola of its data, the pattern of the data. So when the company just looking by the data, and when he read it, he can concluding how much the fixed and variable cost component at a glance, only in a second, because he already know the nature, the pattern of the data of the cost of his company. Okay, many managers simply use their experience. So this is the highlight keyword in here. Experience and past observations of cost relationship to determine the fixed and variable costs. Okay, so yeah, I think that's the explanation of this chapter, the cost behavior. I hope this video will make you understand easier about what is cost behavior.
Thank you and see you in the next video.